Welcome to the deep dive. Today we're jumping right into something big that's really moving the markets.
Yeah, this new initial trade deal between the U.S. and China.
Exactly. We're using Monday's daily open report from CNBC as our guide here.
And the main question we're digging into is, okay, what does this unexpected news actually mean?
Right, what are the key takeaways, the implications? Really, what does it mean for you?
Well, like you said, it seemed to come a bit out of left field, especially considering some recent rhetoric.
Definitely. So what's the core agreement based on the report?
Okay, so fundamentally, it's a 90-day suspension, a timeout, basically, on most tariffs.
Between the U.S. and China?
Yes. And what's really interesting is the level. Both sides are cutting reciprocal tariffs way down.
How far down?
From 125% all the way to 10%.
Wow. Okay, 125 down to 10. That's a massive drop.
It really is a significant shift.
But you said most tariffs, so there's an exception we need to flag.
That's right. It's not quite a total rollback.
Yeah.
The U.S. is holding on to its existing 20% tariff.
On which goods?
On Chinese imports linked to fentanyl. So for those specific items, the total duty heating the U.S. border is actually 30%.
Got it. 10% base plus the existing 20%. Makes sense.
Exactly.
And it's pretty stark when you remember, wasn't it just last Friday President Trump mentioned something about 80% tariffs?
It was. He floated that idea, saying 80% seemed right. So this pivot to a reciprocal 10% cut,
Yeah.
Well, it underscores just how unexpected this development really is.
So beyond that headline 10% number, does the report give more detail on, specific types of goods affected besides fentanyl?
It doesn't really drill down into specific categories beyond that fentanyl exception, but I mean, the sheer scale of the reduction suggests it's pretty broad.
Affecting a lot of trade flows, presumably.
Absolutely. And that reciprocal part is key, too. Both sides are giving quite a bit, at least, for these 90 days.
It certainly signals a major, if maybe temporary, change in the immediate picture. And the markets, how did they react?
Oh, dramatically. Monday saw a really big surge across global stock markets.
Like how big? Any specifics?
Yep. So the S&P 500, that's your broad U.S. benchmark, it jumped 3.27%.
Okay.
The Dow Jones Industrial Average was up 2.81%.
Yeah.
And the NASDAQ Composite even higher, 4.35%.
Big gains, and not just in the U.S.
No, Europe saw gains too. The Pan-European Stock 600 index climbed 1.21%. A bit more modest, but still positive.
Those are impressive numbers. Really shows how tuned in the markets are to this stuff.
Definitely.
And it wasn't just the overall indexes moving, right? I imagine some specific sectors really benefited.
You're right. Tech stocks saw a really significant boost.
Yeah.
Companies like NVIDIA, Broadcom, they had strong rallies.
AdSense and others.
Consumer discretionary stocks, too. Think Nike, Starbucks. They also performed very well.
Interesting.
Actually get to the combined market value of just those magnificent 7 tech stocks. It increased by $837.5 billion.
Wait, in one day?
On Monday alone.
That's incredible. Really highlights the concentration there.
It does.
And it wasn't only stocks moving, was it? What about things like treasury yields? What happened there?
They rose. U.S. Treasury yields went up.
And for our listeners, what does that typically signal when yields rise?
Generally, it suggests investors are feeling a bit more optimistic. Less demand for safe haven bonds, maybe moving money into riskier assets like stocks because they see less economic danger.
So reduced recession fears, maybe?
That seems to be the interpretation. We also saw oil prices jump. And interestingly, the shipping giant Maersk saw its shares shoot up 10%.
Wow, 10% for Maersk. A clear sign of the impact on shipping.
Absolutely. Direct link there.
So, okay, the markets are clearly reading this as good news, at least for now. But it's fascinating how differently the deal is being framed, isn't it? The CNBC report points this out.
It really does. You got contrasting perspectives. From the U.S. side, Treasury Secretary Scott Bessent told CNBC this deal represents progress.
Progress towards what?
Towards decoupling from China for strategic necessities was the phrase he used.
Strategic decoupling.
Mm-hmm.
Remind us what that generally means.
It's basically the idea of reducing economic reliance on another country, especially in critical sectors, like technology or defense manufacturing.
So the U.S. is framing this temporary tariff cut as part of a bigger strategy to actually reduce dependence.
That's the message, yes. A tactical move within a larger strategic aim.
Interesting. Okay, so what's the view from Beijing?
Well, quite different, as you might expect. Chinese officials, various influencers, state media, they're painting this as a win.
A victory.
Yeah, a vindication of their negotiation tactics. The report even quotes a social media account tied to CCTV, China's state broadcaster.
And what did it say?
Something like China's firm countermeasures and resolute stance have been highly effective.
Wow. Okay, so definitely a stark contrast there. Both sides spinning it for their domestic audiences, it seems.
It certainly looks that way.
The report also mentions this idea of the Trump put making a comeback. Can you unpack that for us?
Sure. The Trump put is this sort of market belief, or maybe hope, that President Trump will step in, that he'll use policy levers, often related to trade or the economy, to stop the market from falling too much.
Like an insurance policy.
Kind of, yeah. And this deal, which boosted markets so quickly, has sort of revived that idea, the feeling that he'll intervene if things get rough.
Like a perceived safety net, maybe. But there's a counterpoint in the report too, right? A more cautious view.
Yes. Dario Perkins from T.S. Lombard offers that. He points out something quite interesting.
What's that?
He basically says that the optimistic case for a potential second Trump term seems to rely on him actually reversing many of his own previous policies.
Huh. So the optimism depends on undoing past actions. That's a bit contradictory.
It does raise questions about, the long-term consistency or direction of policy.
Definitely something to think about. Okay, so given these really different interpretations from the U.S. and China, what kind of friction could pop up during this 90-day window?
That's a really good question. Misunderstandings, different expectations?
Yeah.
It's certainly possible.
Let's shift then to the practical side. What does this tariff pause mean for actual goods moving, and maybe for consumers?
Well, according to retailers and logistics folks cited in the report, expect a surge.
A surge in shipments from China.
Yes, a significant increase in freight heading to the U.S. That 90-day pause on those really high tariffs, it's a big incentive.
Right. If you were holding back because of tariffs, now's the time to ship.
Exactly. There's likely a lot of pent-up demand. The report quotes Paul Brashear from ITEX Logistics.
What did he say?
He mentioned having clients with thousands of containers preloaded in China that is ready to come in.
Thousands. Okay, that paints a picture. A backlog just waiting for this window.
Pretty much. But this rush is likely to have knock-on effects.
And I'm guessing that means shipping costs.
That's the expectation. This sudden spike in demand for container space will probably push shipping rates up.
More demand, same supply, higher prices. Basic economics.
Right. And Rick Muscat from Deerstags, the shoe company, gave their perspective.
What's their plan?
They plan to resume shipments from China, obviously, to take advantage of the lower tariffs. But they still anticipate their overall costs will jump by about 40%.
40%. Even with the lower tariffs. Why?
Mainly because of those anticipated higher container shipping rates.
Okay. So the tariff savings might get eaten up, or more than eaten up, by transport costs.
That seems to be their calculation.
And that cost increase, where does it end up?
Potentially with consumers. Muscat suggested possible price increases, perhaps hitting shelves in the fall.
So that's a really important point for you, the listener. Lower tariffs don't automatically mean lower prices if other costs go up.
Exactly. The immediate market cheer is one thing, but the impact on your wallet might be more complicated and take time to show up.
Okay, one last piece the CNBC report mentioned was the technical side of the market rally.
Yes, just briefly. It noted the S&P 500's big jump pushed it past a key technical level.
And for listeners maybe less familiar with market charts, what does breaking a key level usually suggest?
Well, technical levels are often price points where buying or selling stalled before. Breaking decisively above one can signal strong buying interest. It suggests maybe the path is clear for further gains.
And the report connected this to the surprise element.
Yeah, it highlighted the speed of the move. It suggests many investors were genuinely surprised by the trade news.
Caught off guard.
Right. And that element of surprise could mean we see more volatility, more unexpected reactions as the market digests this and hits new milestones.
Okay, so let's try and wrap this up. We've got this surprising U.S. China initial deal. Big but temporary tariff cuts.
Which sparked a major immediate rally in global stocks, especially tech and consumer names.
But very different spins on the deal from the U.S. and China. The U.S. talking decoupling, China claiming victory.
Right. And while it should boost trade volume short term, watch out for rising shipping costs.
Which could mean potentially higher prices for you down the road, maybe this fall.
And the market's fast reaction suggests maybe more surprises are in store as this unfolds.
That sums it up nicely from the report. This deal definitely adds a new layer of, well, uncertainty, but also maybe opportunity.
For sure.
And that brings us to our final thought for you to consider. Given all these rapid changes, the sudden deal, the market's excitement, those contrasting narratives, the potential supply chain bumps, and impact on your spending, what could be the longer-term game here? What happens after 90 days? What does this mean for global trade patterns, for the market's future direction? What questions should you be asking as this situation evolves? Definitely something to keep a very close eye on. Thanks for diving deep with us today.